Welcome to Taking Care of Business on Koerner Radio, News Talk, 1180 for the best in Saturday Talk Radio at 1 o'clock. And now we're on 1230 KGEO at 10 o'clock on Saturday. And for the best in Wednesday Talk Radio on 1410 KERI at Wednesday at 1 o'clock. Your host is Clay Koerner, and I'm Marty Pay. Behind the big board is our producer, Greg Held. Clay, great show last week with City Councilman Russell Johnson and with one of our favorite guests, Sally Pipes, the author of The Truth About Obamacare, talking about your favorite subject, Obamacare.
Sally's in New York this week and also in Washington giving some speeches on Obamacare.
Yeah, talking to some senators who actually need to know more about this bill. Every time we talk to her, I learn something else about Obamacare that scares the heck out of me. That Medicare tax she talked about on capital gains on top of the 30% that Mr. Obama would like to charge people to kind of equal out the playing field, supposedly. The slush fund for new IRS agents, that sounds like another disaster. We've got a great show lined up. In the second half today, we have Lily Marsh from the Honor Flight talking about sending World War II veterans to the World War II Memorial in D.C., and then we have Wendy Porter to talk about the Wounded Heroes Fund and an update on our friends Jeremy and Wesley who are riding across country for veterans. But now by phone we have a very special guest, one who's been on my short list of people that I've always wanted to interview. In my mind, he's the prognosticator's prognosticator, the economist's economist, the editorial board member and senior economist writer for the Wall Street Journal and Fox commentator, Stephen Moore. Steve, welcome to Taking Care of Business.
Hey, guys. Thanks for having me.
Steve, I was trying to find that article that you wrote, and I want to say it was about 10 years ago, before the housing boom, the housing bust, and you predicted the collapse, and I remember reading that article thinking, God, either this guy knows something we don't, or he's crazy. It ends up being the rest of us were crazy. Was that about 10 years ago you predicted the collapse?
Well, you could see all of the cheap money that was being printed by the Fed, and that tale of printing money to create prosperity has never had a happy ending, as you guys know. And then that certainly, in my opinion, was the cause of the bubble that burst. Remember when the technology bubble burst? That was in 1999 and 2000, and then we repeated that mistake through the Fed and Ben Bernanke and Greenspan with all the cheap money, low interest rates, and deluge of dollars in the economy in 2004, 5, 6, and 7, which caused, in my opinion, the bubble to burst in housing. And so, and I would make a case to you guys that I think that we're building up a third bubble in the markets right now with in the bond market. With all this money flowing into the bond market, at some point, people are going to stop lending money to the government at negative real interest rates, which is what a lot of us are doing right now. And I think interest rates are going to start rising.
Steve, this is Clay. I really enjoyed you at the Current Economic Summit last month. You had me on the edge of my seat, actually the edge of the chair. I think a lot of the people were there because it was one of the more interesting discussions that I've heard in a long, long time. But where do we go from here?
Well, I think the way I put it is that almost all the policy dials in Washington are turned the wrong way. We've got a lot of talk about, you just mentioned the Buffett rule and the 30% tax rate on capital gains and dividends. And then, of course, if Obamacare kicks in, that'll be a tragedy for the economy, not even to mention the health care that Americans receive. And you've got the Fed with its pedal to the metal on money creation. You've got all this talk about what we're calling tax-mageddon in Washington, which is on January 1st, the Bush, tax cuts expire. So that really worries me, is that we've got all of these negative shocks coming to the economy if Obama is reelected. Now, look, if Mitt Romney wins the election, I actually think, if you stop some of those bad policies of Obama, you could actually see the reverse. You could see a real bull market expansion. This economy is really ready to take off. The government is holding it back, and so is Washington.
Do you, you mentioned interest rates going up. Do you really think that's going to happen? Because eventually they're going to have to, but
yeah.
But can
the
economy?
Question of when, right?
Yeah. But
all we're just quibbling about is when it's going to happen, and I don't know when. I don't know if it's going to happen in 2 months or 6 months or 5 years, but I do believe that if you guys are nice enough to have me on your show 10 years from now, we'll all say, remember when you could get a mortgage for less than 5%? Remember when you could buy a 10-year Treasury bill at 2%? I mean, I think that's the days are numbered for these really low interest rates, and it doesn't make any sense that people are buying 10-year Treasuries at 2% when we got 3% inflation. I mean, that's a money loser. You're paying the government to hold on to your money.
Mm-hmm. We're having a conversation with Stephen Moore, senior economist writer for the Wall Street Journal and Fox commentator. Steve, what's going to happen to the housing market if interest rates go up? I mean, it's not doing very well now. Raise interest rates, and it's going to be even worse.
No question about it. And by the way, let me just step back a minute. One of the reasons I think interest rates are headed up is because of this insane fiscal policy we've had in place now in Washington for the last, 5 years. The last year of the Bush administration, the first 4 years of the Obama administration, it's been just this deluge of debt. And when you think about it, a rise in interest rates. Let's just speculate and say that we had a 200 or 300 basis point increase in interest rates, which wouldn't be, unprecedented. I mean, in fact, that would just bring interest rates to kind of where they've been historically. If that happened, the debt, because the United States government is the biggest debtor in the world, right? It would have to pay an extra $2 to $3 trillion over 10 years in higher interest on the debt. So the government is in a very precarious situation with these interest rate spikes that are going to happen because it hasn't locked into the long-term rates. It turns over a lot of that. I think the average maturity on the U.S. Treasuries is only 2 or 3 years. So I think we're making big mistakes in not locking in the long-term rates now.
Yeah, definitely.
Steve, you mentioned, or basically the media seems to be in favor of getting Obama reelected, but I didn't get that flavor from you. You don't sound like a supporter, but what's the general feeling about, what's the general feeling in New York and at the Wall Street Journal, since you're in New York and Washington, about Obama being reelected?
Well, I think I would say that, Barack Obama is, I like the man personally. I just think that he's, made a lot of policy mistakes, and I think that it's. And by the way, we don't. I want to make this clear. We don't endorse candidates at the Wall Street Journal, and we don't, endorse their winning or losing. I'm just giving you my own personal opinion. And I think a lot of these policies are really bearish for markets. I mean, this is an investment money show that we're doing right now. When it comes to protecting your money and making your savings safe, I'm not sure that these policies of raising taxes, running enormous deficits, having all these income transfer programs, and building an entitlement state, I think that's a very mistaken view of how you create growth and how you create, growing markets.
Are we looking, Steve, at an area, I mean, a period of time like we had in the 70s where it was a flat market for the next 10 or 15 years, do you think?
It's interesting because if you look at the stock market over the last 40 years or so, we had, the 70s was the worst period, since the Great Depression for stocks. I mean, over the 1970s, stocks lost over half of their value relative to inflation. So that was an incredibly ferocious bear market. Then in the 80s and 90s, once you put in place Reaganomics and Bill Clinton, who I think's policies were pretty fiscally conservative, you actually had one of the greatest bull market runs in the history of this country with, the Dow Jones went from 800 in 1982 to 11,000 by the year 1999. I mean, I do think we could see the potential for a big bull market expansion. Look, there's $2 trillion of capital that's sitting on the sidelines right now that's not being injected into the economy because there is so much fear out there among investors. If you remove that fear and you get people re-injecting that money into the stock market, you could see a real wild run on the upside. On the other hand, if we go forward with the Buffett rule and have all these tax increases, think about if you double the capital gains tax to 15 to 30%. Think about what impact that has on stocks, right? That reduces the value of stocks because we own stocks for their after-tax return, and these are just simply higher taxes on owning stocks, so they make stocks less valuable, and they will mean a reduction in stock values.
When we come back from the break, I want to ask you about Paul Ryan's budget and what chance you think that has of ever passing. We'll be back in a moment on Taking Care of Business on Koerner Radio, News Talk 1180.